Welcome to Mastering Your Financial Life, hosted by Judy Heft, the founder and CEO of Judy Heft and Associates Financial and Lifestyle Concierge. This year, they're celebrating 26 years in business. In every episode, Judy interviews professionals who help others successfully manage their financial lives. You can find this show on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, Stitcher, and more. Judy is the author of 2 books, How to Be Smart, Successful, and Organized with Your Money for a Better Today and Tomorrow, and her latest book, Mastering Your Financial Life Cycles, How to Successfully Manage Money in Every Decade of Life. You can read chapters of her books and catch prior episodes of this show at www.judithheft.com. Now here's the host of Mastering Your Financial Life, Judy Heft.
Hey everybody, welcome. Welcome back to episode 43 of Mastering Your Financial Life. Excuse me. Today I'm here with Natalie Karp. I'm Judy Heft, Financial and Lifestyle Concierge, and we are celebrating 26 years in business. Actually, it's 27 now. Excuse me. I have a little frog in my throat, so I hope you'll excuse that. And so, yeah, we've had this podcast for almost a year. This is our 43rd episode, and today I'm here with Natalie. Natalie Karp is the founding partner of Karp Loshak Long-Term Care Insurance. She's a specialist and an award-winning independent broker, which I love. I love independent insurance brokers because they can go out to every single company and get you the best deals. They're not tied in, so that's great. And Natalie is a trusted resource for consumers and professionals alike. So welcome, Natalie. I'm thrilled to have you as my guest today.
Thank you so much, Judy. So happy to be here with you and your audience.
It's a pleasure. So let's talk, we're going to talk about long-term care, obviously. So why do you think it's important to have it as part of your financial plan?
Well, we're living longer lives. So think about the milestones. 80, 90, 100. It's not unusual to see these birthday cards and these big cakes with all these candles. So we're living longer lives. So really the driver is longevity, living longer lives, having the independence and freedom to live where and how we want to live. So when we age, typically we may need some help. And with help comes really what we describe as very expensive extended care costs. So longevity is the driver, quality of life is the why. And so when we spent our lives making smart choices and building our assets and looking at that allocation, putting a moat around that portfolio to preserve your lifestyle and your legacy becomes a really important conversation to anchor in everything you've worked so hard to achieve.
Yeah, that's really important, Natalie. Thank you for that. So yes, when I got divorced, that was the first thing I did was I went out and I got myself long-term care insurance because I thought, who's going to take care of me? I don't want to be a burden on my children. I want to, make sure I have something in case of, God forbid, an emergency. And fortunately, I haven't had to use it, but that's why they call it insurance. It's there for a rainy day.
Yeah.
So what does it really mean to have private long-term care insurance?
So it really means 2 things. I mean, most people think immediately about the financial. So there's the financial side and there's the non-financial side. So on the financials, it's a pool of money, a bucket of dollars that are very flexible, that allow you to say, I want to be in the home. I want to be in a beautiful assisted living. I want to be in a community care retirement. I want to live internationally. Whatever care is desired is a bucket of dollars or benefit dollars that you can use to provide care. So the financial side is sort of very easy to see. I'm buying $1 million or $500,000 and I'm growing that with inflation. The non-financial side is just as important. So what does it mean? It means that you've got a lot of choice into where, how, and who provides care. It means you're not disrupting family dynamics. You're not compromising your children. Perhaps, there's a blended family. So the non-financial drivers to keep intact the commitments that you've made financially and the emotional part of what care really means. So financial and non-financial is really, two parts of the solution.
Yeah, that's really important. I think that, I think it's the financial that drives us and the emotional is there. And we don't realize, I think if you took the financial piece out of it and we just could do whatever we wanted to take care of ourselves and we didn't have to worry about paying for those expensive caregivers and whatever we needed, then it would just make life so much easier. But you factor in that huge expense because we all know it's very expensive to have in-house caregivers, even if they're not living there part-time, or to go to an assisted living place. Even in assisted living place, sometimes you need to have that care, that private care manager too. And it adds up.
It adds
It
up.
really
And
does.
yeah, and I think, when you start looking at the numbers and you start saying, well, it's $10,000 a month, that's $10,000 from a long-term care, that's tax-free pool of money. So you really, and people living longer, they're very happy in the community environment. You could be in an assisted living for 8 years. So easily you can blow through hundreds of thousands to $1 million. And think about 24/7 care, in the metro New York area. So again, I don't know where the listeners are, but if we're looking at the metro New York area, $25 to $30 an hour is care. You could easily have home care at $15K a month. And that's in addition to your other costs. So care becomes very expensive, and redirecting income from your existing sources may certainly disrupt everything you've put in place.
Yeah, it can be very daunting and overwhelming. I have a client who is a very wealthy gentleman and he's worth over 100 million. But you know what? He has a long-term care insurance because he didn't choose just to self-insure, and he's got that. And really, it helped preserve his wealth that he was handing down to his heirs. So
absolutely.
It turned out to be a good thing. I think a lot of people think, you know what? I have plenty of money and I don't need to worry about it. But there's different reasons.
I think when you're talking about those who can truly self-fund, he's that perfect example. Shifting the risk makes all sorts of sense. It's highly leveraged money, so the financials are so clear. It's highly leveraged money, the opportunity cost of him using his own money, and the tax consequences. So generally speaking, back of the envelope, it's 90% more expensive to self-fund. So you're not simply taking the money out of your left pocket and putting it in your right. And when you look at what he's trying to do for legacy, you can really say this is really a new wealth transfer tax. So for people who are the mass affluent or the high net worth, this really truly would be a wealth transfer tax. So having him put a long-term care insurance plan in place will ensure that the legacy that he wants to keep in place for his children is preserved. So it's smart.
So the dollars that you put into long-term care insurance, are those tax deductible dollars?
If you're a business owner, you have very rich federal tax incentives. So for business owners, there's what we call age-banded allowable deductions in the 50s and the 60s and the 70s. So if you're 70 years old, and you and a spouse buying long-term care insurance, you can deduct about $9,000 combined. If you're a C Corp, you can take the entire deduction. So rich federal deductions are in place. There are also executive carve-outs. And so with long-term care insurance, you can also say, I want to reward certain employees who've been here a long time. I want to show the love in a non-cash way. And you can purchase long-term care. So if you're purchasing long-term care, you can write that totally off. So business owners have a lot of advantage, a lot of leverage.
Oh, that's really good to know. I think that's important. And it's a nice perk to give your employees if you feel you can afford it.
Yeah, it's a beautiful.
I mean, I don't know a lot of companies that do that. I've never really heard anybody doing it, but I think it's a great idea. I love it.
It is. Yeah, for sure.
Yeah, because the hiring market is so competitive. We have to offer whatever we can. We want to give these people incentive to stay with us.
Yeah, well said.
Not just because we're fun to work with. They want the other things too. Well, this is good. So let's take a little commercial break here. We'll come back and we'll talk some more with Natalie Karp.
Hey there. I just want to tell you a little bit about my new book that just came out called Mastering Your Financial Life Cycles. And here it is. It's how to successfully manage your money in every decade of life. I co-authored this with my CFO, Liz Levy. And together we created this manual that's going to help you through every stage of life. We talk about having a baby. We talk about young adulthood, pre-retirement, what to do when you're at that age of retirement. If you're contemplating divorce, do you need an estate plan? We cover all of these, each subject in a different chapter. And I really think that you're going to find this so helpful, because at the end of every chapter, we have checklists that you can look at and you can use, and they can be a guide for you. So this is a wonderful manual that we've created. It's available on Amazon. You can also find it on our website at judithheft.com/book. And we're here for you. If you need anything, reach out. I hope you enjoy the book. Here's another picture of it, just so you know what's going on. Here it is. And I'm really proud of it. It's my second book. And I'd love to have you read it and give me your feedback. Judy Heft, judithheft.com, financial and lifestyle concierge, celebrating 26 years in business. And over the years, I've learned so much. And what I've been trying to do is impart a little bit of this knowledge to you, so I can help all of you become as financially organized as I am.
Thank you. And we're back here with, Natalie Karp Loshak, long-term care insurance. So, I think a lot of our listeners are centers of influence clients, people that work with people that might need long-term care insurance. And then also there's consumers out there listening too. So, if you're as an advisor, where do you, what's a good opening conversation to have with your client, and so that you can suggest to them, maybe this is a good thing to get into your planning with, and we want to talk to you, we can introduce you, and we think this is a good avenue for you to explore. How do we do that?
Thank you for that. It's a great question. I think the first tool is really planting the seeds and saying, have you thought about living longer and what that might mean to your portfolio? Because we want to plan not just to retirement, but through retirement. So when we're executing portfolios to live well into our 90s, it's a perfect time to say how might we mitigate the risk of longevity? And looking at a long-term care insurance solution really is that mitigation tool. You might think about it as an asset allocation. So you've got, your big pie. You're taking a sliver of that pie and saying, let me consider shifting the risk to an insurance company so that they have the liability of $1 million, $500K, $1 million that would be used for long-term care. So, sort of the cute way to say it is, would you rather sign the front of the check or the back of the check? And we're in a digital world, so I'm not really sure how much check writing is going on. But for people who are in their 60s or 70s, the front of the check or the back of the check may resonate. And for those who are really in a digital world, it's, you think about the metaphor perhaps of a sandcastle of all these siloed monies that you've got, and say, well, where's my silo for long-term care so I don't disrupt all these well thought out plans that my advisors have put in place for me, that we thought through. We did 529s, we had mortgages, we made really smart investment choices, and we thought well so that these things would execute as intended. So as to not disrupt what is so well thought out, we really look at long-term care to be that moat around everything you've put in place.
That's a great description. I love that, the moat around everything.
Yeah.
So we talked a little bit about tax credits for businesses, but what if you're just, I don't know, you're just working for a corporation, they don't offer that, and you're thinking, I need to get some long-term care for myself. How does that all work?
So there's a lot of goodies. The federal government and state governments really want to incentivize consumers and business owners, of course, to take action. Why? They don't want you planning on the Medicaid payroll. So as we talked about federally, there's a lot of incentives, but you're an employee of a corporation, you might have some HSA dollars. So if you have an HSA account, you can use your HSA dollars towards your long-term care insurance premium. So that's a triple winner. That's triple tax-free. The money's going in, to your HSA, you're pulling that HSA to pay part of your long-term care premium. And if and when you use your long-term care benefits, that's tax-free. So HSA dollars are beautiful. You may have life insurance with cash value. You're not really using that cash value. It's growing, it's beautiful, but you might say, gee, I'd like to redirect what I think of as dormant money, and let's 1035 the cash out of my life insurance plan. Keep your life insurance intact, just use some or part of the money, and you can fund a long-term care insurance premium there. New York State, for those who have an AGI of less than 250K, will have an allowable tax credit of up to $1,500. So for those who are making $250 or less, we've got a $1,500 credit per contract. We've got HSA, we've got some dormant cash coming out of perhaps an annuity or life insurance. So there's some money out there. We have to do a little creative financing and find it.
So, you know what? I'm already coming to the conclusion after talking to you for a few minutes that whoever is going to think about long-term care really needs to talk to a professional like you, because there's so many tentacles. I was thinking as you were talking, it's like an octopus with all these arms, and there's so many different ways you can go to figure out what's the best solution for you, because I figure everybody's got to be different, you know, depending on all different, you know, your financial situation, your age. Oh, this is really helpful. So, you know, I'm thinking, like, what do you think is the best age to start planning for long-term care insurance?
So with any insurance, the sweet spot is always younger and healthier, locks in good age and really robust discounts. So what we're seeing now is that smart money is coming in the 40s. They've been well advised, which is bravo to their, you know, advisors who've helped them get this conversation moving, or they've had the family experience. If you've had the family experience, you get it, you understand financially and non-financially what the impacts are. So 40 is smart money. Why? We don't need to buy a lot of insurance, because you can buy a small or a modest amount of insurance, really gentle premium, and guess what happens? You put the contract in the drawer, or your digital contract, and it just magically compounds. So we really are able to get to those dollars, those benefit dollars over time, because we've compounded. So that's smart money. The average consumer is coming in at age 57. So I would say between 55 and 65, it's really that flashing yellow light, like, let's do this, get this off my short list and wrap it up in a bow. And, you know, to your point earlier, the driver is very unique to the consumer. So some people may come to this saying, my priority is a big death benefit. Other people will say my priority is I want the lowest, the value for the dollar, and I want to take advantage of all the tax credits. And somebody else might say I want a joint contract with a second to die feature. So how we construct plans is really a big puzzle, and it's a lot of fun for us, and we sort of geek out over that. But there's so many different ways to design plans, because the industry has grown up to be very responsive. So how a 20-year-old is designing plans is very different than how we're designing plans for 70-year-olds. And so we are seeing those with family history coming aboard. We're seeing those who are second marriages, blended families. That's really important, because you want to not have adult children where everyone's in charge and no one's in charge. So there's a lot of demographics. Women. We are 2/3 of the claims, and we are living longer and claiming. So women may have, really to your point, what you said earlier, women are, I don't want my kids to have to deal with this, and I want my independence. So women come to this very clear what is their goal. Men, typically, it's a premium, it's a dollar. They're sort of statistically minded. So we really are looking at women who think about consequences, and men think about statistics. The statistics aren't pretty. 70% of us, when we reach the age of 70, will need long-term care. 80% of us who reach the age of 80 will need long-term care. So the statistics are daunting, and the costs are justify why this conversation has to take place. The younger, the healthier, the more time we have to think through it, the more options we have. At 75, there's still carriers offering, but we might have health stuff. And when we have health stuff, we have challenging underwriting. So what we want to do in the earlier is better is say we're generally healthier and we're locking in that insurability. And that's the piece that for long-term care is the most important part. It's not that the premium is more. Yes, it's obvious. You're older, you're 10 years older, the premium is more. When you wait with long-term care insurance, you may truly, you may become uninsurable. So it's not like life insurance where we have a class of 40. We have preferred, best, and walking dead. You have everything in between. Long-term care insurance really has maybe 2 or 3 levels of underwriting. So you're preferred, you're average, or you're maybe just substandard. We don't have the breadth of that we do for life insurance, and that's because they're writing on not mortality, which is life insurance, but morbidity, chronic long-term diseases of aging. Vertigo, no bueno. Osteoporosis, we really want to get women when there's osteopenia, not osteoporosis. So we need to capture good health. So age is really, when people are ready to focus on this, we encourage younger and healthier.
This was great, Natalie. Thank you so much. It was really informative. I learned a lot, and I'm sure that our listeners did too. So how can our listeners find you?
We can be found by phone. We still pick up the phone, 516-801-1419. Our website is karploshak.com, KarpLoshak.com. And Rona and I would be delighted to help you get educated. We are consultative and educational. That is our platform. We are truly independent. So we like to shop all the carriers so that clients can make confident decisions about what's right for them.
That makes a lot of sense too. And can they find you on LinkedIn, Natalie?
We're on LinkedIn, Natalie Karp, K-A-R-P, and Rona Loshak, L-O-S-H-A-K. So we're a phone call, an email, a DM away.
That's so great. Thank you so much, Natalie.
You're so welcome. Thanks for having us. Thanks, Judy.
My pleasure.
You've been listening to Mastering Your Financial Life, hosted by Judy Heft. Thank you for your positive reviews, comments, and sharing this show with others. You can read chapters of Judy's books and catch prior episodes of Mastering Your Financial Life at www.judithheft.com.